Well, good morning, everyone. Thank you for joining us today for our webinar. Happy to have you with us. I'm Andrew. This is Matt Stewart, our Director of Sales, and you may notice that this is not Sean, who's usually with us. He's taken a great opportunity with a member institution, so we're certainly sad to see him go, but we're happy for him, and glad we'll still have some opportunities to talk to him along the way here.
Good morning, Andrew. It's good to be here. And I was just noticing our disclaimer seems to be growing. So I'm hoping it's not because I'm on the webinar today, but we'll see.
On the advice of legal counsel, they told me just to say no comment. But we have a great agenda here. Hopefully, we'll offer up some things that'll be of value. So a couple parts here. So I'll kick things off talking about the funding side of the balance sheet, both deposits and wholesale, things that we should be concerned with. Matt's going to talk about collateral and ways that you can really get the bang for your buck with your pledge with us. And then lastly, I'll come back on to talk about some things on the mortgage side that we can hopefully look to uncover some liquidity efficiently. So before we jump into, and then we'll have some time at the end for a Q&A. So if you have any things you want us to address, please put it in the chat, and we'll address it either along the way or at the end. So before we jump in, a public service announcement. Our team, primarily our housing and community investment team, will be hitting the road for a number of seminars over the next 2 months. And it's really great program where we'll be trying to find ways how we can help you promote and grow affordable housing in your footprint. So you'll see along the right-hand side the dates and the locations of where we're headed. So please do join us if you can. Share it with your lenders across your organization. Anybody who you think maybe find it to be of use. You can find the information. You most likely received an email related to it, or you can find the registration information on our website.
And I'll reinforce some great programs that they're going to be talking about, and attendance registration has been pretty strong. So definitely don't want to miss out on these events.
Yeah, for sure. So let's jump into the funding side of things. And, I like to start things off with questions. And, is there any relief on the horizon? When is it going to get easier? And I get teased around here as being the perpetual optimist. But even I see more headwinds than tailwinds right now. And it comes down to a couple things. First and foremost, the deposit growth or the lack of deposit growth. And, we're really in uncharted waters here, because when we look back, most of you know we do an awful lot with peer analytics. And in terms of the median members' deposit growth, 5 out of the last 6 quarters for credit unions was negative. And for banks, it was 4 out of 5. So, those are pretty sobering numbers, and really a departure from decades worth of what happens in the banking industry. And it's not just about the quantity of deposits that are coming in or the lack of quantity. It's really about the quality. And we'll uncover that a little bit more as we get in to talk about some of the mix shift that's occurring out of non-maturity deposits into CDs and term deposits. We talk to an awful lot of depositories, and I can tell you, hopefully it makes you feel a little bit better. Nobody is sitting back saying, "Wow, I can't believe all these cheap core deposits are falling out of the sky." That is not an experience that we're seeing or hearing by any sense. And there's these ripple effects of the types of deposits that are coming on that maybe aren't doing the most for us in terms of interest rate risk or liquidity. The other way we can get liquidity is cash flow from existing assets, and there's a lot of pressure there. I'm not telling you anything that most of you don't already know. The prepays have ground to a halt for the most part. We still get some idiosyncratic things happening, but it's really about the amortization of the existing assets. So, and then that can range the gamut from not so bad when you're talking about the auto portfolio, that tends to be a little bit shorter, and to all the way in the other end of the spectrum with the residential portfolio, which is not so great right now, just to get the monthly principal coming back to us. And even the securities portfolio, where that's meant to be a source of liquidity. Certainly the move in rates has put those underwater and create some challenges in terms of affecting sales. But the average life extension for the most part there has really put an added wrinkle into liquidity management. The last leg of the stool here is on new asset growth, and it really pains me to say asset growth slowing down is a positive of any way, shape, or form, but at least from a narrow perspective of liquidity, that is something that is at least trending in the right direction. And over the last year and a half, 2 years, so much has been written and said about the move in interest rates and the challenges in deposit gathering in terms of how that equates to liquidity on the balance sheet. But I think the part that kind of has gone under the radar is that loan demand and loan growth has been so phenomenal. And we go back to 2022, and it was running in mid double digits for many members, which is fantastic. And things have slowed down, right? They can't go up that much in perpetuity. But even now, mid single digits for most. So when you have the tale of two stories, where deposit performance is not so great, but loan performance is so great, that's how we can see those fast turns in the liquidity profile. And again, coming back to our good fortune of being able to talk and interact with so many people across the district, there's certainly a lot of qualitative and anecdotal things that we're seeing in terms of slowdowns in loan pipelines, and there's a number of different reasons for that. It could be on your side of the house, or it could be on the customer side of the house, right? When you're talking about deals where the arithmetic doesn't really tie out, when the borrower, the developer, is at 8% yields, and on your side of the fence, maybe we've gotten a little stretched thin on capital or liquidity, and even the inverted yield curve poses challenges in terms of the margin erosion. So when you net it all out, it's probably a combination of all those things, and your mileage may vary in terms of what things are most impactful for you. And even the other part of it is that in our position as a lender, not a lender like you all, but a lender because we're providing funds. We see things in terms of the borrowing trends that do sync up with that qualitative anecdotal idea that loan growth is really slowing down, in some cases probably considerably. So all right, so much for being the optimist. What an uplifting start to the presentation here. But we'll ask another question: how does it start to get better? And certainly I think many of us are in the camp that the Fed lowering rates will be a step in the right direction. And when you look at that title up top, timing, direction, and magnitude, I think those are the three components of any strategic decision that you make. And the timing is an important part of that. And I think it gets overlooked because certainly with the inverted yield curve over the last year or 2 years, many people have rushed to say, that's it, the yield curve's inverted, recession is coming, rates are going down, batten down the hatches. And that is proven to be early on that call, right? If you had extended assets or shortened funding when the yield curve inverted, and you can see here on the chart, we're looking at Fed funds versus the 1-year treasury rate. If we were looking at longer tenors, like 2 or 3 years, the yield curve inversion began even earlier than that into 2022. And we're now, historically in one of the longest periods of yield curve inversion, but the timing was missed. And I mentioned this before, if we've chatted or you've attended our webinars. When we look back to just a little more than a year ago, the Silicon Valley and the First Republic situations, in both of those cases, when those banks ran into trouble, within a week, the Fed hiked interest rates. So, if you're in the camp of the Fed will cut as soon as something breaks, those are pretty two significant tests of the system. But I think in terms of the Federal Reserve's ability to respond to market crisis, they have awful lot of tools in place, the BTFP being a perfect example of that, how quickly they can act to get things in place to triage and just to keep the market from cratering, like we saw going back, to 2008, for example. But so when we try to reconcile and summarize things, in the subheader there's three important questions that I think we really have to zero in on. Is you don't want to say you're making bets, but I think you have to have some conviction and some assigning of probabilities to the type of scenarios that we're going to see. And I've mentioned it in green on the right-hand side, whether we're going to be in a higher for longer scenario, a soft landing, or a hard landing. And then you have to know what is your balance sheet's pain point, and and do you want to lean into certain exposures that you may have, or are you looking to mitigate them? And you can see here in the table that I've called out 5 years, going back 25 years, and looked at where Fed funds were in March, and then where they ended up the year in December. And you can see that the performance has been pretty mixed. And I'll ask Matt, and I'll ask everyone on the call here, if you know the significance of these years, and I'll give a little hint for everyone out there, that there's a certain geographical segment of the folks on this call who are probably better equipped to answer this question than others. But I'll turn to Matt and see if he can guess the correct answer.
So I'm going to guess the word March, and I'll probably have to say there's some madness in this. So you tell me.
Okay, well, your spidey sense is correct, and if you look at the color codings there, those are the years that the UConn men's basketball team won the national title, and I know all our members down in UConn, in Connecticut, many are avid UConn fans, and they're playing here in Boston tonight, and hopefully for Saturday. You fans on Saturday again. So if you were looking for some correlation between Fed funds moves and UConn basketball, unfortunately, I don't think there's any big correlation that jumps off the page.
No R squared there.
You came here looking for liquidity, tips and tricks, and you probably weren't expecting UConn basketball, conversation. But in any event, we'll move on. So let's look at deposit pricing trends, and here's an analysis of looking at 6-month CD posted rates for all our banks and credit unions going back to the beginning of 2022. And I think the important thing, really important thing to focus on is look at where the annotations are. And I've highlighted in August of 2023 and March of 2024. And that's important because August of 2023 was when the last rate hike was effected. And as you can see from the direction of that trend, we all enjoyed the lag in rates that we were able to lean on as rates went higher, and we didn't have to move deposit rates all that much. But the check has come due. We all know that, and the check is continuing to come due. Couple things here is that this doesn't account for odd term specials or exception pricing, right? Those are some of the immediate response actions that we can take. So these are the benchmark tenors that we're looking at. The other thing, these are just posted rates. These aren't the clearing rates. I've had some good conversations with some of the ALM consultants out there in the universe, and where they have access to certainly different types of data. And the rate, you can post whatever rate you want. This doesn't mean that the deposit is going to come in the door. But when we see what is actually the rate needed in order to bring funds in, it probably starts, if you're fortunate, within 50 basis points of where advance rates are, and in some cases it's either at or through. So that and that poses a challenge, because even if we get into we're not getting that fast pivot scenario where rates going to come down and we can start changing our pricing, that if we do persist for a little bit at these levels, that we're going to see the pressure continue. Even, and this is the scary part, even if rates start to come down, we may still see the bad version of the lag in terms of deposit pricing. So, that's a segue talking about the spread on what the clearing level is for deposits and what the true cost of bringing in any deposit is. And you know, we've talked about this before, the marginal cost of funds concept, and combating that cannibalization. So I told you I'm the ever optimist over here, and so I'll put a glass half full spin on things. Is that when the way the arithmetic works is that if your deposit costs are higher, you know, the pain of getting cannibalized is not the same as when deposits are really, really low. So here we're looking at different levels of cannibalization, shifts from existing low cost deposits into a higher cost offering. And you can see the less steep line, the light blue down on the bottom, that's the existing deposits at 4%, assuming a new deposit rate of 5%. The green is deposits coming out of 0%. So that's where the pain you know, is worse, and it gets worse as that cannibalization rate continues to go higher. But I think the moral of the story is when you think at where's our overnight rate is just north of 550, going towards 5% as you get to the 1-year rate. So you can see there's not an awful lot of cushion before you get from an economic basis to be cheaper tapping into funding, wholesale funding, as opposed to being out there with a CD special. And this doesn't even begin to factor in the dividend benefit.
8.4%. Yeah.
So, you know, wonderful. Theoretical 30,000-foot view. What should we be doing? What are the strategies that, you know, maybe look a little better than others? And so, you know, 3 broad ideas here in terms of looking at the deposit side. We can look at shorter CDs with a high sticker rate. We can try to nudge our way out the curve a little bit with longer CDs. And we can also look at the money markets as well. So, you know, on the shorter CDs, you know, 5%, 5.5% for 5 months, just as a round number example. You know, as we outlined before, that's expensive to wholesale. But the ability to maybe kick the can down the road on this deposit gathering environment, where you can say, you know what, at least the maturity will come back, and maybe in 5-6 months we'll be in a better position. We'll have you know, rates will have come down, or we'll have some asset cash flow, and we won't need to play this very challenging and difficult game. Because when you look at what a 5.5% short-term CD provides for us from an ALM perspective, it's not doing much for margin with the inverted yield curve. It's not doing any, giving us any interest rate risk mitigation benefits. It's not providing much liquidity benefits being at such short tenors. So, you know, the counter arguments to that is, you know, well, we're keeping customers, and maybe we're getting some cross-sell opportunities, and, you know, your mileage may vary. You know, many have said that you know, the rate sensitive one product CD customers, you know, they're not typically the types that are going to have, you know, the benefit to other parts of the institution. Another counter argument, which I think you know, holds water and may be valid, is that if you're doing this from a metric basis, right? It's easy for us as third parties to say, oh, well, you know, this is 1 basis point cheaper, then you should do this, and put blinders on and ignore all the other factors. But if you're collateral constrained, if your loan to deposit ratio is tripping a wire that you don't want to be tripping, then there absolutely is benefits and motivation to be doing something like that on the CD side. Longer term CDs, you know, that's interesting, where it's interesting and it's challenging, because I think that the typical CD customer, we've talked about this before, they don't necessarily agree or understand the concept of an inverted yield curve, right? You should pay me more if I'm going to give you money for longer. That's not quite how the world of interest rates work. So, you know, in terms of the relative cost to alternatives, it's that much more expensive to find the clearing level. But similar to what we just talked about with the shorter CDs, if you nudge out, maybe it does give you some better liquidity and interest rate risk benefits. And not just on its own, but think about it in combination with what you may need or want to do on the asset side. So if you bump out a little bit further, then maybe that gives you some capacity to go longer in assets than maybe you weren't doing, right? Instead of buying 3-year securities, you're comfortable buying 5-year securities, or You were hesitant about making a fixed rate CRE loan. Maybe you feel a little bit better because you were able to extend your funding a little bit. Same thing, change the terms on your autos. Another consideration is, there is the possibility that despite the inversion, we are so high in terms of nominal rates that many depositors and customers haven't seen in a long time. So you can test the waters with those longer specials to say, you know what, here's 4%, lock it in now before rates go down to 3%. Think of people of, before we got into this 5% world, you're talking over a decade where rates were not above 3%. We go back to 2019. I know a lot of credit unions had a lot of success with 3% for 3-year type offerings in 2019 when the yield curve inverted. But something to consider there as you look at different strategies on the deposit side. And last is getting aggressive with rates on the non-maturity deposits, the money markets. And gosh, if there ever was a time to dig deep into the playbook on all the different ways that you can appeal to customers with non-rate features, whether it's no cost withdrawals or teaser rates or things of the sort, now is the time. And I sympathize because it is a tricky game because it's so assumption driven dealing with non-maturity deposits. It's not the maturity and the rate that you have with the CDs that the execution is so important. Because you don't want to cut off your nose to spite your face with getting rid of those core deposits and training people to be rate sensitive. At the end of the day, you have to preserve the value proposition of why folks want to bank with you beyond just you're going to pay me 1 basis point more than the institution down the street. As a reminder, if you have any questions, you should see on the go-to panel along the side, you should be able to enter anything, and we'll tackle it as we go. So, with the challenging environment for deposits, it really puts into focus, what we have to do on the wholesale funding side of the house. And if I don't mention, some specific advanced strategies, I'll get kicked under the table in the shins here, or I don't think there's a taser anywhere around here. When the key advantage of deposits, the cheapness relative to wholesale rates is muted like it is now, then it behooves us to really think about, what can we be doing on the wholesale funding side. And we'll look at 3 different buckets here. Again, I like the questions where we can say, if you have a wall of approaching maturities. So many folks right now have more funding with stated maturities than they have probably in a long time. So whether that's CDs, advances, or even bank term funding program advances. So we know when that funding is going to roll off, as opposed to the non-maturity deposits, which is assumption and decay driven. And we'll dig into this in a little bit, but just to introduce the idea, forward starting advances and the HOB option advances are fantastic ways that we can deal with those walls of approaching maturities. Then the other 2 concepts for us to be familiar with are if we disagree with what is being priced into the current yield curve. So on the first front is that we think that too many cuts are priced in. We've talked about this in previous webinars where the way yield curve calculus works is that we can infer what the implied short-term rate is going to be in the future based off of today's yield curve. So we can look at the 12-month advance rate, and we can figure out what the market is forecasting the 3-month rate is going to be, not just today, it's 3 months from now, 6 months from now, and 9 months from now. So if you have a disagreement or you have a balance sheet that puts you in a position where taking an alternative stance is complementary, then extending that funding incrementally, where however far works for you. It could be 3 to 6 months. It could be 3 months to 3 years. The HOB options in the forwards will work here as well. On the complete opposite side of that is if you think we're in for a hard landing and a fast pivot, short-term rates are going to come down pretty aggressively. And if we think that that turbulence is not just going to be in rates, it's because it's going to introduce a credit event into the market, then we're going to want some stickiness to our liquidity, but we're also probably going to want the fastest repricing that we can, that 100% beta. So our floating rate advances are really tailor-made for those types of situations. So let's look at 3 different advances that I think are worth digging into here. So we have forward starting advances, where they're priced off of today's market, but the funds can be dispersed at a later point. So here we can see 6-month advances, 18-month, and 24 months. We can see the inversion because as we go longer in tenor, the rate goes down. The forward starting advance, 6-month delay, 18-month once it's dispersed, so it brings you out to month 24. That is going to be at a lower rate here. So, to use an example, if you have BTFP funding coming due over the next couple months, well, here's a great way to say we're going to look to replace it now based off of market rates today, and it's going to disperse at that point in the future and really lean off that customization that advances afford you. And 2 things to point out in the forwards is that you don't have to buy stock against it until it disperses. So sorry, no 840 dividend. But the other part is it doesn't use up your collateral capacity until the advance dispersed. And Matt's going to go through a couple key points there. HOB options, we've talked about these for a while because they've been, there's been some relative value, and there's been an awful lot of fit on member balance sheets. So I think what's important here in a point of color to share with everybody is that we've seen a shift towards shorter tenors and really seeing a lot of activity. Not just in the longest maturities with the lowest rates. And I think this is a function of, remember we talked about a few slides back about the timing and magnitude of market rate, of market moves. I think there really is consensus about the direction of where short-term rates are going to go over the next few years. But the timing and the magnitude, certainly there's a lot of uncertainty. And when there's uncertainty, there's volatility. So that is what's created these opportunities here. And when we talk about the different rate scenarios and what is going to perform better or worse, these types of advances are tailor-made for a soft landing scenario. So I'll give you one example. So you can see the gray line there is the 3-year maturity HOB option. So let's look at the 1-year lockout. So the 3-year maturity, 1-year lockout at 424. Let's say that rates go down 100 basis points over the next year. That would bring our overnight daily cash manager to approximately 450. So how would that 4.25 advance fare? Well, you would have saved interest expense all along the way, but the marginal cost, the new funding rate would still be above the coupon that you have on the books. So you save money along the way, and you're still in a favorable position.
And Andrew, the volume of HLB options has doubled from last year, and that's the number, and the actual dollar value is more than 5 times what it was a year ago. So it's been a pretty popular product.
Yeah, absolutely. And the last advance we'll talk about here is the SOFR index advance. And again, this goes back to the short-term rate exposure with the long-term liquidity profile. And as you can see, the pricing is pretty advantageous. When I pulled these numbers the other day, it was cheaper than the daily cash manager when you combine the SOFR index rate plus the spread on the advance. And those spreads are pretty narrow historically. Yeah. So you can see the brightly colored graph on the bottom. It's just a simple ladder structure that if you have if you're forecasting out that we're going to be in a position where we're going to need wholesale funding with some level of conviction over the next few months, then maybe you can get some of those term benefits, but you can keep your interest rate exposure on the short end of the curve. And I like the laddered approach because it gives you some balance that as conditions change, you have the ability to pivot it away. What you don't want to do is necessarily lock in with too much funding, and then all of a sudden you don't need funding anymore, and then you're in a position you'd rather not be in. So, as the funding starts to roll off the early parts of the ladder, you revisit. But in this case, the rate that you're paying is going to be immediately responsive to moves down in market rates.
Yeah, and the other thing I'd point out, Andrew, is there's the sister product, the DNA floater, which is on a 4-week and a 13-week reset. And so that's a popular product as well. That gives you the free optionality to either reduce or to terminate early at the reset date. So that's a sister product to this, obviously.
So we're gonna take it to Matt, and he's gonna go through some collateral things that we should be aware of.
Yeah, thanks, Andrew. So obviously, collateral is a popular topic. It's something that we hear from members all the time, whether they're very active borrowers or whether they're even a little inactive, if you want to say it. Having capacity is so crucial. And what I would emphasize is it's so easy to borrow. You can come in and call at 4:55 or whatever time of the day, and you can get borrowing pretty quickly. But collateral is something that you have to think about beforehand to make sure that you have the capacity. And so when we look back at a year ago during the crisis with the bank failures, we had some fire drills. And so you want to be able to have that collateral. And especially with some of the types that we're going to talk about, it's not something that you can pledge and it'll be there tomorrow. So commercial real estate, mortgages rather, is an example. And so similar to that, I put a plug in that members should be testing their lines on a regular basis to prove that they have the healthy liquidity strategy and demonstrate to the rating agencies and to the regulators that you're able to borrow. And so that goes hand in hand is plan your collateral, but also think about on a regular basis. And what I would recommend is do a borrowing that is somewhere what you would expect to do. And if you're telling the regulators that you can borrow X, well, maybe on the smaller end, you want to do a test borrowing, but do something that is in that ballpark so that it's not just insignificant. And then if we look at the slide here, these are the different types of collateral. And obviously, you're probably pretty familiar with the 1 to 4 families and the commercial mortgages and multifamily. So obviously, with Category 1 members, if you provide the qualified collateral report, what we call QCR, updated on a quarterly basis, those go in, and then we're doing a review periodically to make sure that everything is good. And then what I'll point out, the haircuts on this sheet here are ballpark because they can adjust based on certain criteria. I would recommend that you go into the product and solution guide to see what the haircuts are, or talk to your RMs or collateral department, and they can go through it with you in more detail. The one thing that's not on there, Andrew, do you recognize the obscure collateral type that we don't have listed?
Oh, I wasn't prepared for the trick question, but
Cash. I'll make it easy for you, cash.
It was a trick question, yeah.
We actually have just under 100 million of cash pledged, and I think that's more convenience than anything else. But if you do pledge cash, you have to set up a cash collateral account, and it certainly doesn't make sense to pledge cash to get cash, but it's there from more of a convenience, I think.
So the two answers to the questions today were UConn basketball and cash, like things that most people are around here like. So.
And especially now that you can gamble with the cash is king. All right, so then this is a summary of what's pledged to the system. So this includes all 11 FHLB banks across the country. And you see that single family or 1 to 4 households are roughly half. And then about a third is commercial mortgages and or multifamily. And then you can see that securities are about 15% and the ancillary loans are 7%. So if we switch the slide, this is showing Boston. And there's not a huge difference, but there is a lot more, not a lot, but a 10% increase in 1 to 4 families. So up in the Northeast, obviously we're pledging more of that. Commercial and multifamily goes down. That's really the difference. The securities and the ancillary loans are about the same. So, all right. So we mentioned that the BTFP program is going away, which I should say already did March 11th. And so having the line at the Fed with the discount window is very important. But Andrew and I are a little biased. We feel that the Federal Home Loan Bank is a pretty good source of funding as well. So what you probably will be thinking about is what type of assets you pledge to us versus the Federal Reserve. And on this slide, you'll see the difference. And so our eligible collateral is dictated by regulation. And so if you go into our regs, if you ever get bored, you'll see that it's spelled out what we can and cannot take. And then the Federal Reserve obviously has some ancillary stuff that you're not eligible to pledge to us. And certainly that would be something I would focus on as you're going to the Fed. And I think that the process, you see the BTFP was about 160 billion, and that's going to unwind pretty quickly over the next couple of months. I've read many articles where banks are prepaying and lowering that quicker than probably expected. And then the discount window remains, and we all know that the regulators are looking at that as more of a last resort. But Andrew, the question is, when do you know it's last resort? Look at what we saw last year with, you go into the weekend and all of a sudden on Monday morning, it's the bank's not there anymore. So if we push to the next slide, the thing that we'll point out, we know that the interest rates have gone up quite a bit in the last 3 years. The reference I've always heard is they usually take the escalator up and take the elevator down and vice versa. It looks like we took the elevator up this time and probably going to take the escalator down. But because of the rate increase, we saw the valuations of collateral, the loans come down. And you can see here, the green line is commercial and the blue is 1 to 4 family. And so you can see just 3 years ago how we were above 100% down into the 80s for 1 to 4, and then the commercial just around 90%. But that has an impact, and certainly that has brought people's collateral levels down, and you can see on the right what some of the factors are. Mainly it's the interest rates, but credit spreads and whatnot, and portfolio composition has certainly had an impact. So then if we switch to the next slide. So here's some tips that we are suggesting. So understand that we are now valuing the loans on a quarterly basis, and that was something we switched recently. We use an external source reinforced with our internal modeling. And so that is good because now you're going to get consistency. It's going to be more stability and less volatility that you would see when we were doing 6 months. And then the other thing is, as rates go down, Andrew, what does values go? They go up. So you'll have a quicker appreciation of your loan recognition. So that'll help, obviously, and hopefully we don't go back into a rate increasing mode again. So the other thing is the Category 1 members do not have to list, but if they do, typically it'll be a higher valuation for the haircuts and the loan. So that's something to consider. Right now, there's 320 members that pledge 1 to 4, and about half are listing. And so for those other half, if that's something you want to consider, certainly reach out to the collateral department or your RMs as you may improve your collateral situation. As far as commercial real estate, remember we review those up front before they're eligible. It's a process where you would schedule with our collateral department. And so my recommendation is get notification in earlier than later. Certainly we have several members that are always in queue. And then the other thing is we started a couple months back, year or so or more, allowing provisional. So once you establish a relationship with the commercial team, they consider some easier process for provisional. So And the other thing is participation loans. I won't get into it in detail right now, but just know there's a couple documents that have to be signed up front, and another great way to expand. And then on the security side, you'll see that municipal securities, we included the bank qualified bonds a year ago. And certainly that's a great way for you to add to your collateral. That can go down to issuance of 5 million, which makes a huge difference, especially for the bank, the BQ loans, bonds rather. And then I'll mention to you the non-agency CMBS. Last year, we decreased the number of underlying loan requirement 50 to 25, which makes a huge difference. And we're also accepting the private placements as long as they're Rule 144A, which most of them tend to be. So that's the couple things to point out. The other one I should mention is on securities. We do allow external parties for custodians. So if you have a relationship with any of those that are listed, we're happy to set up an agreement, and it makes your life easy. And or you can just pledge to us, and we use Citibank behind the scenes. Now, one thing I'll note, if it's anything other considered other real estate, which are listed on the bottom, there's a max of a net value after haircuts of 2 times your capital. So still a lot of capacity, but just be aware of that.
Well, thank you, Matt. And, I'll just throw in, especially as it relates to moving collateral to and from the Federal Reserve.
Yeah.
There's a lot of moving pieces involved. And, Matt and his team of relationship managers, they fielded a lot of calls, and they've hammered out the process. So if you have any questions on the things that you need to be doing and things you need to be aware of, right? There's considerations. If you're a Massachusetts bank with a security corp,
yep,
there's some wrinkles there as well. But please do reach out to your relationship manager. They'll help shepherd you through the process, work with our collateral team and the Fed and all that. So we'll wrap things up talking about the mortgage side. So as is tradition, we'll go a few minutes over. I'll try and to speed through.
Hey, don't blame me.
We're talking about liquidity. Everyone wants to talk about liquidity. The path of mortgage rates has created this interesting dynamic. We have 3 buckets of mortgage rates over the last few years, and we'll get into it in a second. But what's interesting to note, no surprise to many, that loan yields of what is held on the books are repricing higher, but at a snail's pace. They've been going at about 15 basis points per quarter, and about 100 basis points, almost since bottoming out in 2022. It's fascinating to me, as I was pulling this data, that resi loan yields have increased more than securities yields have, by about 20 basis points different, which I would have not have guessed, just thinking about, the typical durations of where folks focus with securities and loans. But interesting to note nonetheless.
But it's interesting is my first mortgage was 7%. I thought I was doing pretty well. Right now, that's financial hell.
Yeah.
Look at that.
You want to be in the dark green there. There's 3 distinct coupon buckets here, and Matt's a swimmer, but that's not him, and he's got nicer and brown shoes, not those black ones there. But so what's fascinating is that the aggressiveness of the move in rates has created 3 portfolios within the portfolio. So you have the low coupons that were put on when we had so much liquidity and rates were so low. The valuations are underwater, hence the picture. The mid-range coupons, those are the ones that are, the rates were starting to go up. You felt good about the higher rates, but they have gone up a little bit. So maybe, the potential sale price isn't where you would see new production flow right now. And lastly, the highest coupons, those where, you really top tick the market, but there's a prepayment, clock that is ticking on those loans. So here's a look at pricing from the other day on conventional 30-year loans for our MPF, our Mortgage Partnership Finance program. And when you look at this type of pricing across a range of about 200 basis points, you're always going to see loans priced in this range. It's just a function of which coupons are going to fall in that group here. So we're looking at the mid-range coupons as well as the higher ones. And the circle here denotes where you typically see the new production flow. A common refrain we hear from folks is, with our new mortgages, we target trying to make at least a point and a half, or maybe even 2 points on any sale to pay for all the things we need to pay for. But we'll get into we're not talking about necessarily new production sales, but the stuff that made its way onto the balance sheet over the last few months and even few years, and seeing if there's a way to capture some liquidity. So let's first talk about the low coupon strategies. Now, this is far from a cookie cutter one size fits all strategy, because it involves selling at a sometimes significant discount. So this is this is an outgo discussion, right? Everybody has to be on board. And when you think about the dynamics involved with taking a loss of that magnitude, I think you need the four components that we've highlighted here. That you have to have the motivation to tamp down the interest rate risk. You have to have a motivation to bring some liquidity onto the balance sheet, and your earnings and capital have to be in a position that you could take some of that earnings volatility. So we've seen members affect these transactions because it was a non-negotiable that interest rate risk and liquidity risk needed to be brought back in line a little bit. And the short-term earnings versus the medium and long-term earnings, that the trade-off was where it needed to be. So I will point out something here, independent of, and this is going to be across all the coupon stack. When you think about selling loans into MPF, loans to borrowers with lower incomes, below 80% of area median income, in an effort to support one part of our dual mission, which is to support and advance affordable housing across our footprint. There's going to be a higher sale price potential on those loans that meet those housing goal qualifications. So to the extent that we can put a number on any of those prices of those loans, I think you'd be pleasantly surprised what you see there. And the goal is there, as we talked about, the non-negotiable of reducing rate risk and liquidity risk, is that it allows you the ability to reposition the balance sheet, and that's going to apply for the mid-range coupon strategies as well. And this is where I highlighted three different coupons there, and because of the characteristics of the loan, they're right around par. So it's a 5 7/8 with 85K loan size, so that's a favorable prepayment characteristic. Conventional 6 1/4, and then a 7% high balance, which is going to have adverse prepay characteristics. So most of those they're below the floor where you would normally sell production, but if you've carried it on the balance sheet, you've earned that carry for a number of periods. So the calculus is a little bit different, right? And you don't have a loss that you have to recoup. So it allows you to maybe more efficiently reposition the balance sheet, go into assets that have a more favorable risk-based capital, or a better duration, or a better spread on something. And this is where I get kicked in the shin again. We say maybe you want to delever the balance sheet and pare down some of your wholesale funding. So that's one way that you can do that. And on the highest of coupons, great, you top tick the market, but that valuable option that you give to the customers, the ability to prepay, puts that coupon of that loan at risk. And I'll put on my Dave Ramsey hat for a little bit here and put on the mortgage payment analysis. And without boring you with negative convexity, always puts people to sleep when you say that phrase. But the impact of a 100 basis point drop in rates is different at higher rates than you have at 4%. So you can see in this analysis here, we drop rates from 7 to 6 and 4 to 3. The monthly savings for a $400,000 loan are more going from 7 to 6 versus 4 to 3. That's just bond math for you. So what does that mean? Is that yes, that customer with the high mortgage rate, yeah, they're at risk of prepayments, but it's probably there's a few basis points more or less needed to get them in the money to prepay. So to the extent that you have some of these loans kicking around, and we can see along the right-hand side, you get to some of those higher coupons, and they're trading north of 102, close to 103. I would give a good hard look to see if you can get them off the balance sheet and put yourself in a more favorable profile. So I know we're over time, and
let me, Andrew, while we're waiting, Don't forget the annual stock recalculation will occur next week. So 5 basis points of assets at the year end will be updated. And we have a fair number of members that will have an increase, a lot of it because of asset appreciation over the past year. There'll be some that'll stay the same. Remember, we have a minimum 10,000 of membership stock and a maximum of 5 million. So there's a handful of members that are at the max and they stay the same, obviously. And then there's a handful that will decrease. So communication will be coming out shortly. And so be aware of that.
Yeah, so as always, this presentation will record it and the slides will be up on our website. You'll receive a copy if you registered via email. Even those folks who didn't join us today, they'll get it as well. So you should all see that. And again, hopefully you're familiar with our website where we have the different strategies and insight content that hopefully you find of use. You'll also find the HCI Community Investment Forum calendar and registration. Hopefully you can join us there. And that brings us to the end. Thank you so much for your time. Thanks for the extra 6 minutes and sticking with us. And as always, if you have any questions, feel free to reach out to us and we'll do what we can to help you. Have a great day.
Thanks, everyone.